How many times do you hear people say if you're W-2, there's really not much savings in tax for you? No opportunities, you're W-2 taxpayer. Baloney, we're gonna break open that myth here today. We did cost segs and suddenly zero tax on her $100,000, zero tax on his $500,000 that year.
So she made $250,000 for her family. Just taking what they already had, revamping the facts a little bit, being intentional, not waiting till December, not procrastinating, tackling it and enacting a tax plan worth over $200,000.
Yes. That was awesome. Welcome to this week's Hidden Money podcast. We're excited to talk about this one, Kevin and I. How many times do you hear people say if you're W-2, there's really not much money, not much savings in tax for you? No opportunities, you're W-2 taxpayer. Baloney, we're gonna break open that myth here today.
Agreed. I think there's so much you could do as a W-2 earner. Now, are you more restricted than a business owner? Yes. But who's to say you can't open up your own trade or business? Who's to say that you can't do some things even as a full-time W-2 employee? Who's to say you can't open another trade or business and try to earn some profit doing something else? And then we utilize that as a means to deduct more in tax too.
But that's not the only thing you can do. And we're gonna save that, tease it. You can always open a business to save taxes. That will be next week. Tune in next week for our episode on businesses and starting a business to save tax. So you can't go there. That's off limits for the rest of your stuff. No, you're not allowed to.
All right, fine.
Okay.
So just straight W-2 earner.
Straight W-2 earner. You're not going to open a business.
I'm a good employee. I show up to work, my 9 to 5, come home. My employer withholds taxes without even me making a choice. I have no choice about it, right?
Can I talk about that? Can I interrupt now? Okay.
Not yet. But you do owe tax. So if you make $100,000, I have to pay my fair share of taxes on that. And the employer typically is going to withhold on that, your employment taxes and your federal tax. Mm-hmm. So how do I even begin to tackle that? Because I don't have a trader business until next week. I don't have a trader business. So how do I even start to tackle this?
Great question. I'm so thankful that you finally allowed me to talk. You know, I'm going to go back up before I answer that question because you didn't let me talk when I wanted to.
Deal.
We just had this conversation with our video producer, and she just finished filing her taxes, and she said, we said, how'd you do? Did you pay taxes? She said, well, I got money back. And I said, well, how much did you actually leave on the table? She's like, well, what do you mean? And I told her, you go look on your tax return, page 2 of your Form 1040, about a third of the way up, it says, this is your total tax. That's how much the government kept. She said, I don't want to go see that.
I wouldn't either.
Refer back to our previous episode, The Beast That You Need to Tame. McKinsey, please. That being said, let me just talk about why that is and why the W-2 taxpayers generally pay more taxes than they should. 1913, the 16th Amendment to the United States Constitution was passed. They said, and this is all the whole New Deal, this is when progressivism started. You had Woodrow Wilson and Theodore Roosevelt. They thought if we can make the government bigger and put experts in charge, everyone will be better off. But we need money. And originally in the Constitution, the original Constitution before the 16th Amendment said the Congress shall not, or the government shall not levy any taxes except based on proportion of population, meaning no income tax allowed. Now, they did try a little bit before then during the Civil War, but it got smacked down by a good Supreme Court eventually. It just took a while. So here's how they sold it, though. They sold it, hey, everyone, we're going to do this, but none of you are going to pay income taxes. Only the richest people, I think it was making over $500,000 a year. Don't hold me to that, but somewhere close. But that was $500,000 a year in 1913, which is like 15, 20 million now? I don't know. You can go grok that and let us know in the comment below. So anyways, they said only people making over 500,000, and we're only going to tax 5% of those of the money made over 500,000. That's it. Only the richest are going to pay. It's only going to be 5%. Okay? Well, they started accepting taxes, taking taxes in, and they realized, wow, we're not getting enough money. We want to grow the government bigger. There's so many better things that we can do. So they raised it again, and they lowered it down to normal people. And by the early 1920s, most middle-income households were paying income tax. People weren't liking that. You know, there's another amendment they opened where they prohibited alcohol. That lasted like 11 years because the rest of America was like, heck no, give us our booze back. And they had to put it back in. Well, the government was scared that if they kept going at this rate, they knew they needed to raise more taxes, but if they kept going at this rate, the public was going to demand they repeal income taxes. They couldn't have that. So they came up with mandatory withholding rules by the federal government. Their reasoning was, if the employees never see the money, they never have to send the money to the IRS, like what's happening previously, then they won't care that we're taking taxes from them.
They won't
even know. Drives me crazy, but just a pet peeve. So they instituted that. Now, as an employee, as a W-2 taxpayer, you don't get to see the taxes that you pay. Your employer is required to withhold it from you and send it to the government on your behalf. And I can't prove this, but I have a sneaky, very, very sneaky, well-educated hypothesis. It's a big word for me.
That is.
Hypothesis.
I'm really impressed.
Thank you. That the reason most people get refunds is because they've created these withholding tables to be too much. Bless you. He's allergic to withholding taxes, just like me. So they created these withholding tables to where people generally have more taxes withheld from their paycheck than they're ultimately going to pay tax. I call that stealing because they're not paying you interest on it. It's your money they're taking. And then you file your tax return and you get a refund. And then you have people like our video producer, Mackenzie, like the man in the street. Go YouTube right now. Go look up on YouTube. Look up man in the street or woman in the street on tax day. Or the question asked and recorded, how much taxes did you pay? 19 out of 20 people said, I didn't pay any taxes. I got money back. Not true. You as a W-2 taxpayer are paying way too much in taxes. Do you get a refund? You're still paying too much in taxes, and you gave the IRS a tax-free loan.
You just overpaid
or
your
interest-free
taxes.
loan.
You just overpaid your taxes.
Don't do that.
Yeah. I'd much rather, and it's weird, but you'd much rather owe the government at the end of the year because it means you underpaid if you're not doing any tax planning.
And you got an interest-free loan from the government.
You owe the government, and maybe I owe on my taxes $2,000, $3,000 in taxes. That would be kind of hard if you didn't budget for it.
Yeah,
but in theory, what happened is you didn't pay enough taxes throughout the year at your income level, so you owe the government more, and they're not charging you interest on that if you pay it on time.
If they pay it on time and you get the proper amount of estimated tax, which we work with our clients to help calculate that.
But ideally, we want your total tax. So that's what our job is we're not attacking the refund or tax owed. That is kind of the byproduct of our service. Our service is attacking the step deeper. The total tax levied to you, whether you withheld or not, whether you paid estimated payments or not. We need to attack your total tax. And if we can get your total tax down and you still had withholding, yeah, you're getting a big refund, but we've tackled the total tax problem, not the refund problem. I can get a big refund every year. I'll just pay myself $100,000 a year and I'll do 90% withholding. I'll take nothing home from me, nothing home on a weekly basis or a monthly basis on my W-2. I'll just pay in all my taxes. And then when I file my tax returns, I'll get a 30, 40 grand refund every year.
If you do that, we're dissolving our partnership. Revo Taxpayer Advocacy is no more that's malpractice.
But it's just an illustration of kind of what would be happening in a refund.
Yeah.
It's like you're paying taxes to get them refunded to you. Why do that? And so let's talk through what does that look like. Now, there's some tried and true things as a W-2 employee you should be doing. If you're working at, your employer offers you a 401k with a match. With match or not, you can contribute up into the 401k every year pre-tax. Now, you can do a Roth. There's two different types of retirement accounts. There's your traditional retirement account or your pre-tax account, where every dollar your employer withholds from your paycheck and contributes it reduces your taxable income. But when you get into your 70s, you're going to be hit with required minimum distribution. So you're going to be required to take all that money out. And then you're going to pay tax on that contribution at that point of all the money you stashed away. Now, the reasoning behind that is you get the deduction on the front end, and the government is not going to let you just ride that out until you die to where it goes to your heirs, and then they ride it out, you know? They are going to eventually make you trigger tax on all your pre-tax 401k contributions. So that's the reason for the RMD is they're like, hey, we got you your tax break. Now let's make sure we get taxed. Yes, Mike.
Did you notice how long it was until I interrupted?
Yes, that was good.
I think I broke a record. Thanks.
That was
hard. I'm just going to point out, though, and not all, and I'm not even sure if you agree with me on this. We'll find out. I think maxing out your 401k, unless you're getting matching, it makes sense to max out the amount that you'd get matched in a lot of cases. But I think that should be one of your last resorts for tax planning, because once that money is in the 401k, it's stuck there. It's good to have 401k, but there's so much more you can do with it. And we'll talk about it in tax-advantaged investments, where if it's not stuck in a 401k, you have access to it. The government can't control when you can take it out or how you take it out or tax you on it later. You have more options. But I think so, in my humble opinion, I'm very humble. Mm-hmm. In my humble opinion, you should, you didn't have to give that smirk. I am humble. Ask my wife.
Yeah.
Look at me
just
with my
ask
kids.
me. I'm humble. Yeah.
Yes. Now you threw me off. But I think you should develop a more comprehensive tax strategy. And the 401k should be one of your last resorts, but informed. Make sure you're doing it for the right reason, not because you think it's the only way to reduce your tax. Because how many CPAs tell you that?
Yeah.
Oh, your W-2, max your 401k.
Max your 401k. I mean, it's a step, right? Like, I think a lot of people struggle with saving. It's an easy way to save on the front end without the cash coming in, and then it comes out like your taxes. You don't even know you're doing it, so you can max out your 401k. You may not even know you're doing it, right? And then it grows, time value money. You're a millionaire by the time you retire.
Yep.
So there's truth to that, but there's also truth to it's not my only thing. And it's not going to drastically move the needle. If you're making $500,000 on a W-2 and you max out your 401k, you just dropped a penny in a big pile of coin, right? It's not going to be noticeable. Does it help? Yeah. We're going to stack these tried and true things on top of a bigger plan. It's just also very easy to do your 401k. You don't have to think about it. You don't have to get a tax advisor involved. It's pretty much offered at your employer level, and you just sign up for it and give your percentage, and it's invested. So it's really a no-thought, easy tax way to tax plan. Now, there's also a Roth. You could do a Roth, which is not pre-tax, but it grows tax-free, and there's no RMD on it. That's like a tax plan for the future. You're not really saving taxes today. But let's just take a step back and let me kind of do some tax 101. We haven't done tax 101 at school in a while.
We were supposed to start with that.
Yeah, my bad.
It's about time, man.
Yeah. Well, you gave the history lesson. So you gave a history lesson to tax. You did history 101. I'll do tax 101.
All right.
So tax 101. No matter who you are, whatever taxpayer you are, you could be making $30,000 a year or $30 million a year. It doesn't matter.
I don't make $30 million a year. I don't always point your hand at me.
You're already interrupted. See?
Sorry.
So you got 3 buckets of income, right? You have active income, you have passive income, and then you have portfolio income. Those are the only 3 buckets you make money in. It's important to diagnose where your income is coming from, is because it dictates how you tax plan. If you're a W-2 earner and you make money as a salaried employee, that is in the active category. You are trading time for money. It's actively earned. If you're self-employed, it's active income. You're actively managing your business, making money. That is active. Passive income typically is real estate defaults to passive classification, royalties. If you invest in a business, kind of like Shark Tank, I always think of Shark Tank, like Mark Cuban is not managing those businesses he's investing in. He is a passive investor providing guidance. That business is passive for him. He's not active in the day-to-day, right? So that's a passive income. Then you have portfolio income. Portfolio income is just your interest, your dividends, your cap gains. So it's important to first, where's my problem? Because if I have an active problem, if I have a high W-2, I cannot passively go buy real estate. I cannot passively invest in a business. I cannot trigger a bunch of capital losses in the portfolio bucket and offset my active income.
Most people have learned that one. If you ever had a bad investment in the stock market, you lose $10,000, you're like, oh, at least I get to deduct $10,000. And then you go into TurboTax or go to your CPA, you only get to take $3,000 a year.
Yeah. So you cannot just trigger a bunch of capital losses to offset your W-2. So we have to develop a plan that attacks active income. If you have a bunch of passive income, here's the cool thing about active losses. There's so many ways and unique ways, even as a W-2 earner, to get active tax losses allocated to you. If we can get active losses and you have a bunch of capital gains, active losses are the strongest losses in all of taxation. Active losses reduce passive income, reduce portfolio income. So our goal is to first we diagnose, we define the beast. If you want to know more about that, go to our past episode, our last week. Define where my tax problem is. Then we develop a customized plan to attack that specific problem. I cannot come up with a tailored tax plan for every taxpayer out there. I'm not a blanket tax strategist with 5 tools in my tool belt, because your problem may be a passive problem, a combination of portfolio and active. I have to know where your income's coming from and develop a plan that fits those categories and does it within those limitations, phase out limits. There's so many things at play here, but that's what we do.
Yeah.
So that's your tax 101. You won't be tested on it, but it's good to know. And you could just kind of get a piece of paper and jot down where your income is. And majority of people have an active tax problem. If you're a W-2 earner, it's an active income problem.
Please do me a favor, audience. Go and comment in the comment section below on YouTube or wherever you're watching this podcast or listening to it, and vote. Tell us who's a better and more interesting teacher. My tax history or Kevin's
Tax 101.
Tax 101 buckets. Although that is really, it's good meat, because active losses are the bomb. And that's really what we need in this episode, where we're talking about how to tax plan for W-2 taxpayers. So your W-2 is active income. Only way to reduce that significantly is either through itemized deductions, but that means you're spending a lot of money, generally speaking, or come up with active losses. Let's talk about some itemized deductions. Actually, back up. I know you thought it was your chance to talk, but no, I'm not done. Kevin likes to talk a lot.
I'm starting my own podcast. Mike will have his podcast, I'll have mine, and then we'll have Hidden Money.
And then we can go head to head.
Yes.
And see who can get the most subscribers.
Done.
Okay. But in the meantime, please subscribe and like this podcast, Hidden Money. And comment below if you want to see Kevin with his own podcast. I don't know if I'd watch it. Your wife probably would.
I would have 1 subscriber.
Well, a few.
Maybe 2.
You got a big family. So the way you should reduce your W-2 income isn't the same for everyone. You can have the same W-2 as your coworker, but there's things that matter more to you than others. So we have a client that I was talking to a couple weeks ago, a new client, tax planning, and they are very charitable. They were wanting to provide a house. They always tied 10%. They also wanted to buy a house for this family a needy family. And that's important. They're going to do it anyways. So if they just go buy them a house and give it to them, there's no deductions there. But they're going to do it anyways, right? This guy was a really cool guy, pilot. So I said, why not start a charity, a 501c3? Let's put together a board where you're not the majority owners or the managers of it. It's a charity to help people who are hard up in your state go and help them get a foot up and get a house. At least get the down payment for them and help them with rent. Like, I can do that? Yes. They were going to do it anyways, and it wasn't cost them over $100,000. Guess what? They get to deduct that $100,000 now from their W-2 as a charitable itemized deduction. Mm-hmm. Your coworker might not want to do that. He might not want to go buy people houses. Your coworker might want to invest in real estate. Maybe your coworker has waited all year and didn't think about this. One of the beasts, procrastination. They come to Kevin December 1st. Dude, I got $500,000 W-2. What can I do? Some options.
So there's many. You're not out of the game in December. Now, going to the procrastination, it's going to be a rush and it's going to be a little stressful. We got to educate and get you deployed out into these investments. But there's leveraged investments out there that provide trader business losses, but also provide appreciation on your investment. They provide cash flow, but you could put $50,000 down and get $250,000 of a tax deduction.
Legally.
Yes. And Mike and I do these strategies ourselves. So
yes.
Mike and I, we practice what we preach. Like this year, we're targeting an actual commercial property as our tax plan. We're diversifying. We have oil. We got real estate. We are doing everything we talk about, and we're utilizing these investments are all saving our taxes, our CPA income. So there's so many ways to do it. But that it's a good diversification strategy. But if you came to me in December with a $500,000 W-2, I could probably save 70, 80 grand in taxes.
But you only have a few options at that point.
You only have, you have probably 3 options that we can deploy to tackle large active income with a minimum investment of probably $50,000.
Yep.
Would be kind of where.
But they come to you in June 1st. There's so many more opportunities.
Dude, just think about this. So let's say you're a W-2 earner, you're married and you got 3 kids and your wife stay at home. Your wife does not have a quote unquote trader business job where she's getting paid. Now she's working.
Oh, she's working harder than we are, yeah.
But there's ways to utilize her to offset the other earners.
Actually, if the 3 kids are 3 girls, I don't know if she's working as hard as my wife is with the 3 boys. So
yeah,
it's
that's
just
true.
So
you need
she's
to balance
probably
her out.
Higher.
But we could utilize, if this was part of our tax plan, we could utilize your wife's non-employee status to develop a tax plan revolved around that, and maybe we can get her qualified for some tax breaks, significant tax breaks. And because y'all file jointly on the same tax return, if your wife is able to bring to the table a bunch of tax breaks because she's staying at home and we can get her over some hurdles on some tax planning, they offset your income because you're filing joint and those 2 net. We can get her a bunch of active losses that offset your active income.
I have a great story that I love telling. And I don't care if you've heard it 100 times, Kevin. Just stop interrupting, please. Anyhow.
Go on.
Physician, new physician, had just gotten out of his residency. He was starting to make money, and he realized how much tax he was paying, and it was a lot. He thought, wait a second, I'm finally making good money. And he's realizing he's not getting anywhere. He's running on the treadmill. He has a wife, 3 kids. She was working hard, but she's not working. She's working hard with the kids. She doesn't have a job. You know, I think that is sexist. The IRS has to change that part of the code. But this is the code we have to work with. So she doesn't have a job. He'd already wanted to invest in real estate and had, actually. Long-term rentals. He got a couple duplexes. But he couldn't take depreciation off his active income because, as Kevin's 101 explained, that real estate was passive to him. The only way that real estate could become active is if he or his wife were a real estate professional. So we talked to his wife. And at first she said no. She's like, I'm busy enough. But he was able to convince her, why don't you study and get your realtor exam and license? Worst comes to worst, we can at least save some on commissions when we buy our next rental property. But she might like it. So she does, gets 350, 400 hours that year, just studying before, taking the classes, sitting for the exam, 400 hours. She needs 350 more to become a real estate professional. She was already managing those duplexes that he had. She was already doing that because he was at the hospital all the dang time. There was another like almost 200 hours of stuff she was doing, especially when she had to turn them around after a person left. So boom, she was at now 350, 450, 550 hours. She only needed 200 more hours. So she was talking to her friend up the street at their club, and the friend said, hey, I love realty. I don't do it a lot, but you know, I have this realty practice. It's fun. You get to look at houses, show houses, and occasionally you make a big piece of money. So she said, I'll try that, but I'm just going to do it with my close friends and family. So she got the realtor license. She starts working with a realtor friend. She spends another 300 hours a year showing houses. She had like 3 sales. They had 100 grand. Husband said, wow, that's great money. I interfered and said, no, that's her money. She earned it.
That's her bonus. Sorry.
That's her bonus. But when she did that, they became real estate professionals. They had all this real estate already. They hadn't bought any new property. It We did cost segs, and suddenly zero tax on her 100,000, zero tax on his 500,000 that year. It was awesome.
So when you combine the tax savings, you got $100,000 of commission, plus probably 150 in tax saved. So she made $250,000 for her family.
Yeah, it was more like 180,000.
Yeah.
Yeah, so she made
significant money for her family by just
huge
taking what they already had, revamping the facts a little bit, being intentional, not waiting till December, not procrastinating, tackling it, and enacting a tax plan worth over $200,000.
Yes, that was awesome. That changed. And
would you work 700? I would work 800 hours a year
to make 280,000.
Yes, who wouldn't? So there's so many ways. You know,
my sons wouldn't.
You might need to make them.
I'm working on them.
So there's so many ways if you're a W-2 employee. If we didn't get into every example here, there's leveraged things, there's charitable ways, there's real estate, there's oil and gas. There's so many ways to tackle your W-2 problem, and it's just can't be squeezed in a 25-minute episode. So please go to revotaxpayer.com, click schedule a consultation, talk to our team. Let's just see where you're at. Where have you tax planned in the past? And if you haven't, it's okay. We're changing now. We're moving forward. Get educated on what items are out there because people are utilizing the tax code for their benefit. Don't be left behind. So go to revotaxpayer.com and join us next week on the Hidden Money Podcast. So please like, comment, subscribe, share this with a friend. You got a buddy making a high W-2? Send this to him. We'll help him out too. So thanks, and we'll see you next week.